and welcome to this episode of Investing Not Rocket Science. We are past 10 episodes and one portfolio update so far. In the first episode, I defined a basic portfolio framework. The objective of this investment is to beat inflation and an equity index. The value of this investment is 1 million US dollars, and I'm looking to invest into equities and bonds. I plan to actively manage this portfolio without the use of leverage with a time horizon greater than 5 years. And the investment universe I'm looking at are the developed and the emerging markets. The benchmark for this portfolio is the ACWI Investable Market. From episodes 2 to 5, I added Google, Infineon, and Emerson to this portfolio. In episode 6, I evaluated government bonds and I shortlisted the UK gilts to be added to the portfolio. There was a portfolio update, post which I looked at automotive stocks and added BMW. From episodes 8 to 10, I looked at European, US, and Asian financials and added Deutsche Bank, Citi, and ICBC to this portfolio. In total, I've analyzed 35 stocks so far and added 7 of them to the portfolio. Alright, so what does a portfolio look like? In today's episode, I'm going to look at the second portfolio update. It's been nearly a month since this series started, and it'll be interesting to see how this portfolio has performed. Okay, in terms of its performance, the portfolio is up 0.1% and largely driven by a performance in equities. Fixed income has detracted performance in this portfolio, and cash has added on slightly as well. In the meanwhile, the benchmark has fallen 4.6%. So clearly, the portfolio has outperformed here. I would call this more of beginner's luck for the reason that we've added on positions into this portfolio gradually and over a period of time and not in one go right at the beginning. So that's one of the reasons why this portfolio has outperformed the benchmark. Nevertheless, it's a good start. Equities, fixed income, and cash. You can see that the fixed income is almost 35% of this portfolio, and we still have about 41% in cash and about 24% in equities. There's still some distance to go before we are fully invested in this portfolio. In terms of the regional allocation, almost evenly distributed between Europe and the US, with a 1% allocation to Asia currently. In terms of the top performance in the portfolio, this has been largely led by Infineon and Google. Having the UK gilts in this particular portfolio is that it reduces any currency volatilities and fluctuations. So, whatever the US dollar would probably gain or lose would ideally would be made up by the other currencies, which are GBP and Euro. Okay. In terms of the portfolio details itself, this is what it looks like. The UK gilt, it's unclassified. Because it's in bonds. That is slightly negative at the moment. Stocks are up 1% and cash is up about 0.1%. Among the equities, financial stocks have come under some selling pressure this week, and I can see stocks like Citigroup and Deutsche Bank are already down between 3 and 4%. I picked up ICBC just yesterday, and it's already down 1.2%. Okay, whereas our technology stocks, especially Infineon and Alphabet, they are up more than 3% in this period, and they're also heavyweights on the portfolio with nearly 5%. Let's look at what are the portfolio risks. And in the week ahead, I have geopolitical risks that I need to consider: the U.S. and China, and the war in Eastern Europe. Um, Interest rate risks: we have the ECB, which is going to announce its interest rate decision next week, and the week after, You have the Fed and the Bank of England announcing interest rate decisions. There's inflation risk, which could impact this portfolio. So, CPI data is something that I'm watching out for. And macroeconomic risk, I'm watching the data for retail sales and industrial production. I'm looking for trends to see if there's going to be a slowdown, or are we going to go into a recession. All of these questions matter because they could directly impact the portfolio. Company specific risks, constantly monitoring the financial reports and the news, especially of the companies on the portfolio. And finally, in terms of stock selection, what are the stocks or sectors I'm going to look at? On the right here is an illustration that I saw at a interactive broker website, and this basically talks about the various sectors that tend to do well uh, during various business cycles, such as in recession. Generally, investors tend to load up on defensive stocks such as utilities, consumer staples, and healthcare. And during a recovery, it's usually industrials, materials, or real estate. And during a expansion or a growth phase, tech stocks do very well, and consumer discretionary as well. And finally, when there's a peak, financial stocks or energy and materials would do well, because these are the times when interest rate generally tends to rise. And here's where interest rates pause, and here's where interest rates begin to come down. Usually, this is the case. In this particular economic cycle, we really don't know which part of the cycle we are in. We definitely peaked out in 2021, and we are not really sure if there is going to be a recession or not, or should I just skip these sectors and move straight into the recovery portion of it. There's definitely a slowdown in economic activity, there's no doubt about that. And most of this slowdown has been priced in, I think, into the stock market. So that was the portfolio update. This is Investing Not Rocket Science, a series on building and managing an investment portfolio. None of this is expert advice, I'm just learning alongside you. Please visit our website for the full disclaimers and terms of use. And you can connect with us on any of our social media channels or follow the blog on www.claritech.app. Thank you for watching, thank you for your time, and I look forward to seeing you in the next video.